Welcome, Gordon McKemie and Mariann Montagne to the Think Tank Exchange. Talking billions with people who manage billions is always fun for me. Gordon is the managing director of the Blackstone SRLN fund. That's SRLN is the symbol, and it's SBDR Blackstone Senior Loan ETF. And of course, he also is the manager of the Blackstone High Income, and HYBL is that symbol. And then the Blackstone Floating Rate Enhanced Income Fund, which is BGFLX. And Mariann is a portfolio manager at Gradient. And Mariann, thank you very much for joining us as the financial advisor. And you bring in extra experience because you're a portfolio manager as well. And so with that, let me start with you, Mariann. Just if you could tell us a little bit about your firm and your thought process and your background, that would be great.
Okay, starting with my background, I've been a CFA for over 30 years. I have been on both the buy side and the sell side, so I know the pain of each and the glories. And I have been with Gradient for the past nearly 8 years as a portfolio manager, managing only ETFs these last several years. I manage about 1.1 billion out of the 4.6 billion at Gradient. We are a third-party asset manager. We have a boutique type of approach that a lot of advisors and clients can't access elsewhere, in that our 4 portfolio managers will gladly talk to any of our clients at any time about their positions. So we're a very high-touch type of firm. We're ranked in the top 5% in terms of growth of assets under management. So it's been an exciting ride here.
Yeah, we're dealing with different circumstances than ever before. It's great that you bring up the fact that clients can talk to the portfolio managers, because I think that makes a huge difference, because we're in for different times. Conditions have changed, right? So Gordon, tell us a little bit about your firm. Of course, everybody knows who Blackstone is, but talk a little bit about the firm and your background.
Sure. So I've been with Blackstone Credit for about 10 years, and for the last 7, I've been a portfolio manager for our publicly listed funds. Prior to that, I worked on the sell side in both leveraged finance and high yield research. Actually started my career at Lehman Brothers and their loan group. Blackstone probably doesn't need too much of an introduction, but alternative asset manager, about 880 billion of AUM. Blackstone Credit is about a little over a quarter of that, about 240 billion of AUM. We're focused on sub-investment grade corporate credit. So a range of strategies within that. And generally we are among the largest players in many of those strategies. I sit, and SRLN and the listed funds sit in liquid credit strategies, which is about a little less than half of that AUM, about 110 billion. A few just data points to give a sense of our scale. We have just shy of 100 professionals on our liquid team, averaging 15 years of experience. We're the largest buyer of new issue loans in the market. We've received about 18 billion in new issue allocations in the last 3 years. We're the largest manager of CLOs in the world. CLOs are over half of the loan market. And we're also generally the most active, or among the most active, managers in the secondary market, looking at number of trades. So our research team, which is over 30 professionals, is driving idea generation, and we're implementing those. And so it shows up in our secondary trading statistics as well.
I've been in the business now for 30 plus years, and we're definitely in different conditions than we ever have been in the past. We've got inflation, we've got the Fed hiking. The question is going to be, is your normal 60-40 portfolio going to work in the same light as it has? So senior loans, to me, fill a void that arguably, hasn't been that necessary for years. I mean, all due respect, Gordon, you guys have built a huge business around it, and it's important for companies to have access to senior loans. But now conditions have changed. So talk to us a little bit about how flows have occurred as a result? And just generally, what exactly is a senior loan? Because let's start with the basics as well.
Sure. So a senior loan is essentially corporate debt that's rated below investment grade. So it's generally to large, often household name types of companies. The average company that we're lending to is over $2 billion in revenue, just to give you a sense of scale. So a lot of household names, and generally speaking, they are companies that are sophisticated, and they'll optimize their capital structure. So they're looking at different ways to finance themselves. They'll look at floating rate debt. They'll often look at high yield bonds as well. I would say that in our market, the more stable sectors tend to be more represented. So technology, for example, is the largest sector in the syndicated loan market, which is a sector that we quite like. So it's been, it's compared to high yield, which many are familiar with. Loans are very similar in many respects. Also, corporate debt, also below investment grade. Loans are a bit unique in that they are senior secured, and so you're first in line if there is a default, and thus the recoveries tend to be higher than in high yield, much of which is unsecured. We also are floating rate, which is quite important in this environment. So when the Fed hikes, our portfolio is a floating rate plus a stated credit spread, and so our portfolio will increase as rates rise, the floating component of the portfolio. And so when you look, for example, at performance, you've had this very sharp move in both near-term rates and in the 10-year loans. The broad loan benchmark S&P LSTA broad loans is down year to date through yesterday -2%, -0.2% total return. High yield is down 4.9, S&P 500 is down 3.1, investment grade corporate down 7.8%, and the ag is down 6%. So it's been one of the very few asset classes that has been stable because you're not taking much duration risk.
Yeah, I was explaining to a client the other day, and people don't realize this, the way bond math works, right? There's an inverse relationship between price and yield. Mariann, talk to us a little bit about what you're seeing in some of your client discussions, and what, by the way, maybe with financial advisors or the end user.
So what we're telling our clients is that we're anticipating a long-term upswing in interest rates and a real headwind to bond values. And this navigation of that type of scenario calls for choices we've not had to consider in nearly 2 decades. The Fed has guided us to about 265 additional basis points in the Fed funds rate over the next 2 years. And we believe that could be conservative given current inflation and sustained inflation. So we're slicing and dicing the globe to unearth opportunities for yield and positive total returns. And that's something that should be of real concern to people who are trying to invest that 40% on the fixed income side in a traditional manner. So we're scouring the globe now for various instruments, including convertible securities, shorter and medium duration fixed income, everything from junk to government-backed securities, while also looking at changing credit spreads.
Yeah. So what I'm hearing from you is people aren't giving up on their need for income, right? That's part of the problem, right? People still need that income.
Oh, absolutely.
Yeah. So okay. So obviously, what this means is that senior loans fit neatly in an overall allocation. Gordon, when I'm looking at senior loans, I'm also wondering about private equity a bit, right? Private equity has been very quiet, in my opinion, over the years. Do you see some increased activity and really the market for senior loans expanding over this period of time?
I would say that the supply and demand dynamics in loans tend to be quite well balanced. So when you have a period, for example, of dislocation, you'll see the new issue supply be curtailed quite sharply, which gives the market a chance to return back towards par. That tends to be what typically happens. And so I think that it's been a bit of a slow start to the year for private equity. Some of that could be that private equity generally likes to make high conviction bets on companies that they like, and uncertain environments make it more difficult to control your own destiny. And so if we were to get some more stability, one could think that that could return given the amount of dry powder that the private equity industry has. But would expect it to would be fairly balanced. I mean, when we look at still rates moving up, but historically they're still fairly low. So the financing market, I think, once you have some stability, will look quite attractive.
And talk to us a little bit further about Blackstone's position in the space, in terms of what happens when a deal comes to market. I mean, I think there's a huge benefit to active management in certain asset classes, and I think yours is one of them.
Yeah, I think that's right. I'd say that one thing that we as a firm have seen is when you have the environment that we're in, where when you look at the ag yielding 2.9% and the 2-year break-even inflation rate is 4.5%, you have this need to allocate away from traditional fixed income. And so you're looking at other asset classes. And I think that can include private credit, that can include real estate, certainly, as you need to replace a lot of ag that is essentially locking in a negative real return in terms of your purchasing power. And so I'd say from our perspective, the growth in our, for example, direct lending business has been helpful for us on the syndicated side, because many times the companies coming to our market, we've already done significant amounts of diligence with the company beforehand, and that's something we're able to benefit from. So our position in the market certainly benefits, particularly in loans and high yield, where there's a lot of focus on avoiding the downside. That's something that takes some time to dig into with the company and figure out what can go wrong. And that's something that I think are very well positioned to do in the market.
So Mariann, when you're talking about active versus passive, are you mostly thinking, I want alpha on the upside, or are you mostly thinking I want downside protection or management?
The answer is yes. So when we're looking for active management, and we're willing to pay up for that. I mean, there's, lower fee ETFs that we can put into our portfolios, whether it's on the endowment side or looking for absolute yield. We can put in some more standard run-of-the-mill ETFs with very low expense ratios. But we're willing to pay up for those areas of the market that demand real expertise. And of course, we can't do that with our team. So we're looking to places like Blackstone, who can provide that. We just think it's even more crucial to success this year than in the past, due to that high rate of inflation and the impact on corporate profits. So we're looking to them also for the diversification. That's a great attribute of ETFs overall, but even more important in this space when you're dealing with below investment grade. We're looking for quality. They're screening for quality. These are asset-backed notes or first lien claims on the proceeds from the sale of assets securing the loans. I think most people don't realize that, but that's a great pecking order to be in before all other claims or interests on the business. And then certainly we're looking for that high yield. As of the 30th of March, we saw 4.14 on the SRLN, and short-term credits, corporates, were more like 2.5%. And of course, we can go back to that rate in the basement for government issues, and it's 0.03 for the 1 to 3 month T-bill.
Yeah, You just threw out some great stats, how conditions are changing. So along those same lines, what is the outlook, right, by your firm, Gordon, on inflation, what the Fed might be doing?
Well, I'd say that we've seen the market. It appears to be coming around to a view that we've had since, I'd say, mid last year. Some may remember that in December, one of our highest conviction calls from Byron Wien, Joe Zeidel, and team was that the 10-year would hit 2.75% this year, driven by our view around tapering, economic growth, and Fed hikes. Keep in mind, this is at a time in December when the 10-year was between 1.4 and 1.5%. So 130 basis point upward move was quite out of consensus. And of course, we've gotten about more than halfway there. So the other item that we've been focused on is that inflation would be persistent rather than transitory, and we've had this view, and we've been fairly outspoken about it last year. So how do we form that view? So our real estate business, which is about 280 billion in assets, could see our data in mid last year that rents in our markets were rising at historic rates. Around the same time, in our private equity business, which has about 260 billion of AUM, over 100 portfolio companies, several 100,000 employees. When we surveyed our CEOs, which we do each quarter, the challenge to find qualified labor was one of the top concerns and has been. So we saw a very tight labor market. So we're seeing the strength in labor markets and in housing in real time. And unlike lumber or used cars or oil, rents and wage increases they tend to be quite sticky. So that informed our view last year that the Fed would need to act fairly aggressively to get ahead of inflation. So it's increasingly looking like the Fed is, of course, going to hike quite dramatically, more than many were expecting. I think the consensus is that from the market is that inflation will return to target next year, so about 2.6% in 2023. I'd say that in our base case, we would expect it to be elevated for a bit longer, and that's driven primarily by our view that shelter, which is about a third of CPI, is going to have some inflationary pressures that'll continue for the next year or so at least. That's based on our view that home prices tend to lead the shelter component of CPI by about 15 to 18 months. And home prices were up about 19% in January, and shelter has only been up in the mid-single digits. So our sense is that has a lot of momentum and may continue to drive inflation. So our sense is that we think certainly we've been of the view that inflation would be high and not transitory. And our view is now that the market we would be above trend in terms of the next few years for inflation to continue.
Yeah. It's very concerning, right? When you've got this headwind of inflation that people aren't used to, and it affects industries differently, right? You have the ability to underweight or overweight different industries and different credits. Talk to us a little bit about, Gordon, the significant moves that you made historically.
Well, I'd say that inflation is interesting in that it's a tailwind for floating rate credit risk. It is a bit scary for long duration low yield fixed income. And so the latter is obvious why. When prices are going up 7% and you're earning 2% on a elongated bond, doesn't feel like a great place to be. But for our credit markets, inflation is a tailwind in a sense that even a company that is struggling is able to nominally increase its revenues and EBITDA with inflation. Obviously, it varies by industry, but because their level of debt doesn't increase, it can, on the margin, reduce the default rate. So that's a reason to be in floating rate, and of course, because the Fed deals with inflation by raising short-term rates, which means our portfolio, the floating rate component of it increases as the Fed hikes. That's a positive place to be. So, I'd say that from a credit risk perspective, we feel pretty good about the market in the sense that dislocation. Of course, we saw an uptick in defaults in late 2020, mid to late 2020. Defaults hit 4.5% in loans and about 6.5% in energy, in high yield, much of which is driven by energy. But since then, we've fallen to near all-time lows in terms of credit losses over the last 12 months. And the expectation is that we're going to stay well below that. One of the interesting things that when we dug into the defaults that have occurred, about 70% of the defaults were loans that were trading below 90 cents as of January of 2020. And so it had this effect in some ways of clearing out some of the weaker companies that already had issues from the market. And as a result, the market feels quite clean to us. Combine that with inflation and our expectation for modest or fairly strong economic growth, frankly, in the U.S., we feel quite good about credit risk.
Mariann, you're hearing all that, and obviously you've been active too this past 6 months, year on making changes to your portfolio. What type of changes have you made?
I think the general direction has been higher quality, but at the same time looking for higher yield, short duration, the typical things you're trying to achieve. It really involves depending upon those providers of ETFs who do the scrubbing on the credit side. I think that's just been a huge benefit to our performance. And I wanted to point out that back in 2008, tranches made all the difference between success and failure versus market-weighted indices. And as Gordon was talking about, there are low-quality companies that have had to add debt, and so in the index, that makes them a larger portion of the index. So all the more reason to switch away from some type of index to a team of professionals who can scrub the credits and allocate appropriately, as a portfolio manager to those undervalued credits.
I would be remiss if I didn't ask you both about, how you view energy prices going higher, right? Has that caused you to be more concerned about your fixed income portfolios, or have you made any changes in that regard?
I view the energy prices as very temporary, as they've risen, because of the war, and it's not changed my strategy.
Gordon?
Yes, we've been through. We use our research team to go through an exercise as we do when things become topical to look at exposure, and overall it looks quite light. First, from a U.S. perspective, we're of course better off than Europe. Higher gas prices are a headwind to consumers on the coast generally, but a tailwind for consumers in the middle of the country. The benefit from higher oil prices net. The impact to commodity exposure from a first lien perspective, and we have made some repositioning moves that where we saw some commodity exposure where we could swap sort of dollar for dollar, same relative value, but remove commodity risk or lessen commodity risk, and we've made some of those active moves. But when you think about where loans sit in the capital structure, you generally are starting off with 30 to 50% loan to value. And so while if you have a business model that is locking in contracts for many years or is highly exposed to one commodity and their competitors are exposed to others, you can create long-term issues. But generally speaking, because there's a large amount of equity below us, there's often unsecured debt or second lien debt below us, that generally speaking, commodities are something that prove temporary from a loan perspective.
Now, you also manage a high income fund, right? Has energy benefited that fund?
It certainly has. We launched a fund in February, which we're very excited about, and I'll say it's the approach here is one of our fastest growing strategies on the institutional side. So it's essentially multi-asset credit. So we're investing in loans, high yield bonds, and we also have an ability to allocate to CLO debt securities as well. So the the allocation process is, which we can go through, but to look at the impact of energy, of course, because high yield is about 12% energy exposure, you've seen energy benefit. So it's something that you need to, I think about over a long term. So we've had historically, when you've had high oil prices, there's been an increase in rig counts, which leads to a correction some years later. And so it's something that we do think about quite closely. When we look at the recoveries historically in energy high yield bonds, they also tend to be lower than the high yield market average, which is in turn lower than the loan market average. And so it's something that we look at closely, and it is a nuance between the loan and the high yield market. So part of the strategy with this fund is that there are a lot of nuances between the two markets, but they are quite similar in many respects. They are corporate credit, and generally driven by similar factors. So the approach here is that we're taking a top-down approach. We're looking at macroeconomic trends. We're looking at market technicals. The loan market tends to be quite technical, which we can speak about, and then relative value. And we're trying to determine how best to allocate that marginal dollar between loans and high yield and CLOs. And then within those three asset classes, we take a bottoms-up security selection process. So we tailor that to each asset class. So on the loan side, we use the same discretionary process that we use for SRLN, analyst focused, deep due diligence. So a more traditional discretionary approach there, minimizing losses, and then if the market dislocates, look for opportunities. For the bond side of HYBL, we're using this data-driven, scalable approach to determine every single day, where do we think each bond should be trading based on our view of credit risk, specifically probability of default. We look at that intrinsic fair value, what we believe fair value to be, and we compare that with where bonds are actually trading, and we overweight or underweight accordingly after we apply the liquidity screens and some other approaches. So that's a strategy we've been very excited about. We acquired a firm in late 2020 called DCI and have integrated them into our team, and it's really bolstered our entire offering. We're finding lots of ways to improve even our legacy process by leveraging that team and their skill set.
By the way, Mariann, you haven't been in the ETF think tank. Feel free to engage and ask questions as you're hearing some of the things that Gordon is saying. And Gordon, you were talking about HYBL mostly right then, so that's great. Mariann, if you have a question, I can keep going. Otherwise,
no, I just refer back to our experience in absolute yield with the MLPs as a way of playing oil prices. And we really shy away from a significant exposure to energy. So 12% kind of, gets me right about there. And it's really based on experience. And I have to tell people also that MLPs do not trade in a tight correlation to oil prices. Sometimes it goes just the opposite way of what you were hoping. But energy exposure is something that our clients do ask about. And we really want to keep that to a minimum and kind of ride the longer term prospects. And as Gordon was saying, higher prices for oil begets lower prices. And that's true of any commodity. So yeah, we just take a stance of trying to minimize our positions in energy.
And I think if I could add to that, expand on that, when you have a low yield environment, there is a need to generate income. And so you look at things that are above a hurdle. And there are things that, and going back from my time at Lehman, I learned this lesson well. There are things that are above a hurdle and they may seem attractive and they may be attractive, but there's a limit to how much you can allocate if you're relying on that for income. And often one of a few things will prove problematic with that. It could be highly correlated to one industry. So MLPs may themselves be attractive, but if it all goes wrong, it's all going to go wrong. It's levered. Leverage, of course, can enhance returns over time, can add volatility. It is esoteric, so it's a hard asset class to understand. And if it falls out of favor, you have to sort of wait for it to be understood again, or ultimately, pay you out. Or it's junior in the capital structure. Of course, you can get paid more for taking more junior risk. And one of the things in our conversations with clients who are trying to solve that income gap, essentially, is that SRLN doesn't have those features. It's unlevered, it's senior secured, it is diversified by industry. So technology is the largest sector at 13%, and that in and of itself is diversified because they're serving different industries. And it's about as easy to understand as it can be. First lien senior secured to multi-billion-dollar revenue companies with loans that tend to only stay outstanding 3 or 4 years. So that's I think something that that can be unique in the sort of search for yield environment. The one downside to caveat, of course, is that there are periods of time where you will see outflows from loans. But what tends to happen, because the retail investors in total are generally only about between 5 and 15% of the loan market, there can be some outflows, but you tend to get that back fairly quickly. And so even during COVID, for example, even in years where you've had some outflows, you tend to get back towards par in fairly short order. So anyway, it's an interesting asset class from that perspective.
Well, and just for all those reasons that Gordon just stated, we rely on his expertise and the team's expertise for that portion of our overall portfolio that's in senior loans, because they have taken that bottom-up approach, incorporating the first lien status in order to utilize energy in their portfolios.
You don't have 100 people, reading through the docs and visiting companies and talking to management teams?
No, if only we could find even a couple.
So switching it up a little bit, we haven't talked about tips, which is thought to be an inflation hedge. I don't know. I'm going to turn it first to you, Mariann. Is that something that you are using in your portfolio, tips in general?
Not currently. We did use it earlier last year, and when taking into consideration all our potential choices, we've just found other things that are more beneficial.
And Gordon, you've got a view on tips, of course.
Well, I'll say that, generally speaking, of course, tips have the inflation protection, but we've been quite comfortable with credit risk. And so we think it's an environment that we expect the economy to grow. We expect defaults to be relatively low. So at SRLN, our monthly annualized distribution about 4.5. Of course, we would be positioned on the floating rate component of that portfolio to benefit from Fed hikes. That we think that it probably makes sense to be paid to take some credit risk in this environment.
Yeah, I struggle with tips as well. You actually have to really know what you're doing, I think, in that area of the market. I'm going to throw a curveball question at you both, and Gordon's smiling on this one. We do a happy hour every Thursday, and often we're talking about the MOVE index. I'm sure you guys are familiar with what the MOVE index is. Is this something that you look at as well? And I'm going to throw it first to Gordon.
It's frankly not something I look at very closely. Just looking at the volatility as a volatility measure. It's not something that we're looking at closely. Oftentimes when there's broader volatility, and I'd say the volatility, it's been interesting that volatility across all markets, traditional fixed income and equities, has been driven and dominated by rate moves. And so people are, I think, appreciating that equities, particularly technology, has duration. And so because we've been seeing fairly consistent inflows into loans, and we're not exposed to duration, we haven't had much volatility in our market. Other than we did have a bit in recent weeks. We had a 13-week streak of inflows And then we had 1 week of outflows recently. So we had some volatility, but we've snapped back pretty quickly. So generally speaking, much of the volatility you'll see at other markets, we don't tend to experience as quite to the same magnitude as in the loan market.
Well, you can't change your strategy because the move index spikes up, right? It's a rear view mirror index for you, I suppose. So, Mariann, you familiar with the move index?
I'm not, but I'm not interested in review pictures of anything.
Sounds good. That's fine.
I'd love to come to your happy hour and learn more, though.
Hey, 5 o'clock every Thursday. What can I say? So, Gordon, you've seen some real inflows into SRLN. Is that because people or investors are now becoming more concerned about the issues that we're talking about?
So I think certainly you see when you tend to see the expectation that the Fed is going to hike, you do see inflows. I think thankfully some of the inflows have been market share gains. So we've been increasing. I think some of that is in turn driven by performance. So we've outperformed the mutual funds over the last 5 years. The Morningstar Loan Mutual Fund average by a little over 5% cumulatively, and outperformed the passive ETF by a bit more over the last 5 years. So I think there has been a shift in market share, but no question we are seeing pretty strong inflows. And I think as we think about the next let's say year, let's look out a year or so. Generally speaking, when the Fed is in the midst of a hiking campaign, you do see the technical support from retail investors into loans. And so it's I think in part one of the reasons why loans have had such relatively low volatility has been that support from investors into loan mutual funds and ETFs.
Yeah, you meaningfully outperform the ag, which impresses a lot of folks. So I'm going to turn it to the audience here. I've got a couple of questions. I'm just going to read Jason's question first. He's been very patient. He writes, "What are the yields being generated in direct lending now, and are these all senior secured, floating rate? Isn't there a lot of competition now for let's say for these deals, potentially resulting in less covenant conditions and lower yields?" Is this something that you can answer?
Yeah, I think that when we think about both the direct lending market and at least the loan market, they are both typically floating rate markets. And so the expectation is that the floating rate component should increase as the market's expecting about 9 rate hikes in the next 11 months. And then you could see some spread compression, but of course, some of that is driven by the expectation for very low defaults. So some of that would certainly be expected. And one of the reasons that credit loans, but also high yield, outperform the ag typically when the Fed is hiking is because if they're hiking, they're generally expecting economic growth and thus low defaults. So in terms of, I'd say, competition between the two markets, I'd say they're more complementary. Certainly from our perspective, as I mentioned, we benefit from that team's ability to do diligence on companies that for a month or more with other potential buyers, and then the companies come to our market sometimes, and we benefit from that team. I think that there are still relatively, when we look at the average size of lenders in our market, they're on average about $3 billion of revenue in the syndicated loan market, and so you're at about 800 million of EBITDA. So you're still talking about very large companies. There have been growth in direct lending as we think makes sense given this environment. You're looking for higher yielding vehicles because those are longer term vehicles, not daily liquidity generally. They'll use leverage, so that'll enhance the yield profile as well. But there are very few firms in direct lending who have the ability to finance companies that the average company in the broadly syndicated market. And so I think that the broadly syndicated market, as I mentioned, the supply demand dynamics are such that that they tend to correct themselves, and so you don't. For example, when you look at the CLO buyer base, which is about over half of the loan market, they're essentially looking at the math of are loans attractive for is the credit risk I'm being paid attractive versus the default risk I expect to take, and then relative to how where they finance themselves, and so I think that the relative value in the market, again, the risk you're taking, what you're being paid, seems quite reasonable. It wouldn't surprise us if floating rates increase, and there could be some spread compression. But overall, the market tends to be quite balanced.
So going back to the audience, I think same person writes, are Blackstone's new deals all based on SOEFR, or do they have floors? And what is the average?
Well, I'll say that so we saw a very, very significant shift in the market this year. So if you look at the fourth quarter of last year, 90% of the new issue loans were LIBOR based, and year to date, nearly all of the truly new deals, excluding add-ons, have been SOFR based. So we do think the market is making a very sharp transition. We saw that play out. Most existing loans are, of course, still LIBOR based, but they generally will contain fallback language. So there's a mechanism to transition if they aren't refinanced beforehand, which, as I mentioned, loans typically stay outstanding. They're issued. Generally, a first lien loan will have a 7-year maturity. Mm-hmm. The portfolio remaining life for SRLN and most other funds is 5 years. And because they're refinanced usually 2 or 3 years early, they tend to have about a 3 or 4 year average life. So we do think the market is in pretty good position to transition to SOFR in time for the LIBOR cessation.
Wow, it's a lot out there, right? So, how are liquidity spreads generally for, they write SLOs, but I think they mean CLOs. That was another question from the audience. Liquidity spreads
is that in terms of trading the CLO exposures?
Yeah.
Well, CLO debt certainly is less liquid than loans or high yield, both of which are highly liquid, as we've demonstrated in a number of dislocations since our inception. We've been able to turn both into cash quite readily. And so I would comment that CLO debt generally is a bit wider. The market is a bit less liquid. When you have even a modest allocation, it can be quite accretive. We certainly wouldn't rely on CLO exposure for liquidity needs. But it is a market where when you look at the performance of CLO debt, you've had a de minimis number of defaults over a long track record. Part of the benefit of the CLO structure is that if defaults begin to accumulate in a CLO, the cash flow is diverted to start repaying debt. And so it is a longer term vehicle that is structured to withstand defaults. And as a result, you've had very, very few that have actually defaulted. And thus the CLO market has grown pretty consistently consecutively for 10 years. And so we think that is justified based on the performance track record. So it can enhance a portfolio, which is one of the reasons we were excited to be able to include it in HYBL. But it is a market where it can get choppy to trade, and so we're generally looking for those opportunities. When we see, for example, if the CLO market were to have a bit of a disconnect or a dislocation, and the loan and high yield market didn't have nearly quite the same dislocation, then that's the opportunity that we would see to add that sort of risk that we felt comfortable with.
Yeah, I remember when I did the interview with Lee Shaman back in 2014, in an emergency, you also have a credit line set up with SRLN, which I don't think you've ever tapped. Is that fair?
We have not. It's there. Yeah, it's prudent to have in place, of course, but generally, I think there's a misconception that loans are, take T+10 to settle, and that's that could be the market average. Of course, the buys, when you buy a new issue loan, it can take longer to settle, but you're also getting compensated with a new issue discount. Generally speaking, when we're looking to sell loans, we can sell it to the banks who have other types of buyers that they're usually selling to, namely CLOs and institutions. And then it's a matter of their middle office closing out the trade. So we can request a short settle, and we can often settle loans in T2, T3. So we've had a number of dislocations since we launched the fund in April of 2013. We had big drawdowns in December of 18. We've been through a number of stress tests, and not only have we met our liquidity needs, but every other loan manager has met their liquidity needs. So I think there's a bit of a disconnect in perception versus the reality that we see in terms of turning loans into cash. So we have the credit lines, but have never actually needed to use them.
Sure. So Mariann, coming back to you, in your fixed income portfolio, have you changed a lot on your views on how you manage duration as well?
Yes, with the caveat that I will stretch for yield in some situations. And I guess I'll give the example of overseas government sovereign debt. It has a more typical of an ag type of duration, but we're capturing a lot of yield premium over emerging market corporates, emerging market junk. So, I'm going for higher quality, higher yield, and willing to take on a little longer duration. Again, it's a portion of my fixed income portfolio, and as part of that budget I talked about earlier in terms of not just expenses, but also duration.
Yeah, interesting. So Lily Ploy, who's been a great member of the ETF think tank, is actually asking about the utility sector, Gordon. Utility sector is highly regulated, right? Is that a sector that you guys, focus in on, and what might we be looking at in the way of utilities in lieu of inflation? Do they have the flexibility, with the regulators?
Yeah, it's a good question. Not a big exposure for the syndicated loan market. You do see some power plants and power portfolios that, but generally not still the large utilities. So not a big part of our market. Generally speaking, I think that one of the challenges for some of those credits is that they're relying on something that can be out of their control. Of course, they'll have long-term contracts in many cases with investment grade off-takers. But it's just generally, there are things that are a little bit out of their control and harder to diligence. When we look instead at a technology company or a healthcare company, of course, the latter, you have stroke of the pen type risk that we have 3 healthcare analysts who spend a lot of time looking at that. But I think we're generally able to get more comfortable with a company's strategy and speaking with their management team, speaking with the sponsor if there is one. And so that's been one of our preferred sectors. And even in the recovery, we've benefited from being overweight some of the consumer discretionary sectors like theaters and airlines, where we went overweight when they were at very steep discounts, and we've reduced those to some extent, taking some gains. But that's the sort of diligence I think we're positioned to do. It's kind of hard when you're just sort of taking a guess on commodities. It's a tough place to be.
Yeah. So Mariann, here's kind of a random question. 5 years from now, maybe when inflation is less of a concern, are you looking at this also as an opportunity to, maybe not right now, don't get me wrong, but to lock in really neat cash flows for some of your fixed income?
Yeah, I mean, every day starts a new time horizon. And to be honest, my time horizon is December 31st of this year. But, we're trying to do the best we can for those who are seeking income right now. I mean, there's just such a heavy demand for that. And, it's front page news every day. The cost of everything is higher. People have absorbed that. They know that's their world. And they're trying not to fall behind in their purchasing power. And so when I'm looking out 5 years from now and say we're up in that 3 to 4% area on the Fed funds rate, I think the story will be pretty much the same. We'll just be scouring the markets to try to give them improved purchasing power under the current conditions.
Yeah, I love that as a comment, because that's what we eat and breathe, right? We go to the grocery store, we don't want to not buy something because we can't afford it. So at the end of all these, we conclude with the financial advisor, or in your case, Mariann, you as a portfolio manager, your highlighted charity that you'd like to speak about. We'd love to hear about it and how you made that choice.
Well, it's the Girl Scouts. Everybody knows what the Girl Scouts is, but what they may not realize is that involvement with the Girl Scouts, starting at an early age, leads to much higher skills in science, technology, engineering, math, otherwise known as STEM, involvement in the outdoors that they might otherwise not have had, other life activities, and entrepreneurship. So as a result of all these skills that can last a lifetime, the alums are more likely to have career satisfaction, to be at management positions, and to have a positive impact on both the local and global community. So I'm a proud alumnus, as are each of my daughters, and I strongly encourage people to include the Girl Scouts in their charitable giving.
Thank you very much. I will relay that to my daughter, who was obviously also a big believer in it. Of course, my son should be too. Gordon, thank you for your participation. Your questions and insights were really helpful. These are difficult times. People don't appreciate it. And Mariann, thank you for your insights as well. I like your answer about maintaining the purchasing power for people. Have a good day, everybody.
Thank you so much, Dan. Thanks, Mariann. Pleasure to speak with everyone.
Thanks.
Bye-bye.
Bye.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities or other financial instruments, and may not be construed as such. Past performance does not guarantee future results. This interview is being distributed for informational purposes only and should not be considered as investment advice or recommendation of any particular security, strategy, or investment product. It does not constitute legal or tax advice. The information provided is not intended as a complete analysis of every material fact, and the underlying assumptions and views are subject to change based on market and other conditions. All investments involve risks, including possible loss of principal.